Hello, folks. G'day. To everyone out there in the live land, I'm your host, Stefan Angelini, and I'm here hosting an ASX Stock Tips education event. I'm also the host of the Investor Types podcast, and here we are for a great event talking to an expert manager in the small cap and mid cap space. We're talking to Nick Greenwood from Karara Asset Management. Most importantly today, guys, it's all about education, educating yourself and getting yourself upskilled if you are thinking about trading shares. Obviously, trade responsible. Anything you hear in this conversation today will just be general in nature, so please don't consider it as personal advice. If you are considering taking on any personal advice, please go and speak to a licensed professional. All right, g'day everyone. Welcome to the stream. Luckily, we've got here today, so Nick Greenwood from Karara. We've got Renee Dacchino from Ironbark Asset Management, responsible for the distribution of Karara and many other funds. And also Daniel McDonald, who runs McDonald Legal, but also was a creator of the Facebook group. So guys, thanks a lot for joining us, everyone. G'day. Great to see you. Look, we're here to talk about small caps, obviously, get some education on investing. Renee, you've been in the investing game for a long time. I thought you'd be the best person to introduce Nick and even the fund. So if you wouldn't mind.
Thanks, Stefan, and thanks, Daniel. Yes, so I'd like to take the opportunity to introduce one of our portfolio managers from Karara Capital, Nick Greenway. Nick Greenway joined Karara as an investment manager in May 2010. He has over 20 years investment market experience, and prior to joining Karara Capital, Nick worked for more than 8 years as a portfolio manager and an analyst focusing on listed Australian small companies. Most recently, prior to Karara Capital, he worked with a firm called Patriot Asset Management, where he was also managing director and co-founder. Prior to joining Patriot, Nick worked as an investment banker with UBS Warburg Corporate Finance and Merrill Lynch, where he held the position of vice president in investment banking. So as you can tell by the bio that I just read out to you all, Nick has a wealth of experience, and I'm sure that you'll enjoy our session today.
Amazing. Well, Nick, thanks for joining us. You've obviously got a wealth of experience, and you're in the most exciting space in the stock market, but obviously also the most volatile, and we'll call it the most emotional, with the roller coaster that go up and down. And if you look at the ups and downs of, say, some of the buy now, pay laters, where in March they were skyrocketing and then they fell. If you look at Afterpay, went from $40 down to $8 and then back up to $90. And it just goes to show some periods of market volatility that if you don't, I guess, back up your buys and what you're buying with research, it's easy to get emotional and to run away. Tell me a bit about your experience with market volatility and the approach you take when we're in such volatile markets like we're seeing now.
Thanks, Stefan, and thanks, Renee, for the introduction. Yeah, I think the volatility through this year has been really interesting, and I think it really represents the culmination of a market, particularly in small caps and micro caps, that has been heavily driven by momentum, and the share price swings can be a lot more volatile because the liquidity in those stocks is so much less than, say, the top 20 or top 50. I think really, the key is in this sort of market where you do have these wild swings is to have an anchor, or you have to have a reference point or a valuation for your stocks, and so you have the buy price and the sell price. Otherwise, if you're just moving with momentum, it's very dangerous, and you could have been holding Afterpay at $30, and it takes a lot of fortitude or confidence in your valuation anchor to hang on to it when it's sinking like a stone down to $8. And I suppose that momentum isn't really our investing style. We tend to be more of a fundamental investor and rely on some more traditional earnings and dividend type aspects in coming up with our valuations. And so it's been tough for a value or a more value orientated manager for us in a momentum driven market. But I think either way, whichever style you follow and either are valid at various times, you really have to know what your buy and sell prices are. Otherwise, you're just moving with the crowd.
Yeah, definitely. Now, growth momentum has certainly been shooting the lights out. Hopefully, value is making a comeback for sure. I might just introduce you to Daniel McDonald. So Daniel is the creator of the Facebook group, and as I said before, so runs a law firm out of Melbourne. Daniel, any questions you've got for Nick before we kick off the presentation?
Yeah, I'm just interested to know, Karara's been around since 2009, Iron Bark. Just wondering how it all came into existence.
Karara was actually founded by three gentlemen, the managing director, David Slack, who was a founder actually of Portfolio Partners going back into the 90s, which was sold to Norwich. And then two former colleagues of his from when they worked at Invesco, Rowan Walsh and Luke Sinclair, formed the company.
Gotcha. Right.
And obviously,
how these things come
within the company, there's a few different focuses. Nick Greenway obviously leads the Small Companies Fund. So, Nick, what we might do is I might get into the presentation. For anyone that's out there that is watching, and if you do have questions for us, please feel free to leave a question. It will pop up for us, and then we can ask Nick to go from there. Other than that, Nick, you're going to see this presentation pop up on your screen. Over to you. Let me know where you want to go, Nick, and talk to the slides if you can.
Okay. Well, just on slide 3, just gives a quick overview of our investment objective and essentially what we're trying to achieve. Our benchmark is the Small Ordinaries Accumulation Index, and we're trying to achieve that over a rolling 4-year period. The size of the fund we manage or total funds we manage in this strategy are about $800 million. In terms of what we invest in, we don't really go down into the real really small end of the micro cap or the nano cap market. So we don't hold any companies with market caps of less than 70 million. Well, that's actually a hard rule. And in reality, we don't own many that have a market cap of less than 200. So our real sweet spot is companies that have market caps from 200 up until those companies really move into the ASX 100. And by that stage, you're looking at companies with market caps of over $2 billion and thereabouts. We can hold 15% of our fund in those companies that move out of the small cap index up into the top 100. We currently hold about 10% of the fund in those sort of companies. One of our main ones actually has been a gold company called Saracen Minerals, which we've held for a long time and done really well out of. And you probably would have seen yesterday that they announced a merge with Northern Star to create the second largest gold company in Australia behind Newcrest, and actually has much better growth prospects than Newcrest. And that's been well received by the market, which is good. Turning to slide 4, our fundamental philosophy is to buy companies that are underappreciated or mispriced, and we have a quality focus. So we try and invest in what we refer to high quality companies that preferably have sustained earnings or sustainable earnings, or a materially undervalued asset position. And this sort of focus on earnings really goes to that fundamentals or focus on fundamentals I was referring to before. And I suppose in this sort of market environment where you have had a lot of non-profit generating companies, really flying, particularly in the tech space and so forth, it has made it a difficult market for us to invest in because we do have a focus on profitability. What we do though is have some scope to invest in non-profit generating companies, and that's principally of advantage in the resources part of the market. We have a lot of companies that are say, developing a mine or a project, and they're pre-earnings or pre-revenue, and often you can do very, very well out of those companies, and we have. So we do have the ability to invest in companies that are non-profit generators. At the moment, that's well below less than 10% of the fund. And obviously in the tech space, you've had companies like Afterpay and Zip, and most of the buy now pay laters are not profitable. We have had some exposure to them over the years. We did own Afterpay when it was in our benchmark and made some pretty good money out of it. I think we sold out at $25 or $26 and thought we were legends, and it was fully priced. And obviously it ran up into the 30s, and then obviously went on the journey we've described, back down to 8, and then up obviously into the 90 level. We sort of invest with a longer term horizon, so we're not we're not traders. Essentially we'll buy stocks with a view to holding them for 3 to 5 years. That's sort of the time frame we look at when we're making our investment decisions. So we're really trying to find those underappreciated medium-term growth stories, not trying to find the next stock that's we think is going to fly up in the next week or so. In terms of our approach, it's really based around discipline. We're bottom-up stock pickers, but I think a key point of difference for us compared to some other managers, we do take a lot of account of the broader macro environment with a top-down overlay. And we sort of spend a lot of time understanding, companies and industries, and particularly where those companies sit within an industry and what the challenges and threats are. And fundamentally, we're not a deep value manager, albeit we do have a value orientation. We're not looking to buy stocks that are impaired or in structural decline. So we're not like an Alan Gray type manager who will buy those really bombed out stories and wait for the or hope for the big turnaround. Once again, that's a valid investment style, and they're a very successful manager and done really well. That's just not our investment style. So probably the next point in terms of the presentation, if we turn to slide 6, how we're sort of seeing the market overall at the moment and some of our positioning. At the moment, I think that the market is quite expensive, particularly the small industrials part of the market, and a lot of the tech names and software names and buy now pay later sort of stocks are looking pretty fully priced. The market has been massively supported by stimulus, really since the GFC. You've only got to look at what the central banks around the world have done in terms of printing money, expanding their balance sheets, and now that's really being augmented by government fiscal policy. You've obviously seen massive direct transfer payments in Australia with JobKeeper and JobSeeker and the like, and now with the budget last night, albeit that there's a transfer or less reliance now on direct handouts from the government to more tax incentives in terms of giving businesses tax breaks and personal income tax rather than direct handouts. The markets, I think, still will be supported for quite some time by the actions of the government as well as the central banks. So how we see things and how we're playing it in terms of our key portfolio thematics, there's obviously been a massive acceleration in digital transformation driven by COVID and working from home type concepts, increasing data usage in cloud computing and e-commerce. So in that sort of data or digital infrastructure space, we've owned companies like NextDC and Vocus in terms of communications infrastructure. We've also had Opticom and Unity Wireless more in the more focused the household fibre data consumption thematic. As more people are working from home, essentially those companies are competing with the NBN in rolling out infrastructure and long life assets. And there's actually a merger that's going through at the moment of those two companies. We're pretty positive on that part of the market. Infrastructure expenditure is really going to be a linchpin also of the domestic economic recovery into FY22. Obviously, the government, at the federal level, there's over $100 billion of projects that will start coming through. That there is a bit of a lag, but we think companies such as Seven Group over the medium term will be a very strong beneficiary there. Mining services is actually a really interesting part of the market. It's really lagged the relatively bullish resources market. So obviously the gold stocks have been flying, the iron ore stocks have been flying, but a lot of the mining services companies have really lagged that. And we think there's some pretty good value down that part of the market. So a couple of companies we own there. One is Mineral Resources, which is also an iron ore producer, and it's got some tier 1 lithium assets as well, and also NRW, which we think is undervalued. Emerging inflationary pressures. Key sort of thematic there is our exposure to precious metals, primarily gold. I think at the moment you haven't seen the inflation really manifest in terms of consumer prices. It's been more in asset prices. And we may see some moderate deflationary forces going forward, but I think the actions of central banks and governments pretty much universally around the world to borrow and spend, as far as the eye can see, will mean that inflation will emerge in the medium term. And so we've got some good exposure there through some gold stocks such as Saracen, as I mentioned earlier. Then just lastly, in terms of a couple of other key themes we're seeing or where we have exposures to, Australia is, I think, increasingly playing to its natural advantages and demand for high quality food coming out of Asia. So some of the exposure we have there at the moment are Elders and Costa. And then East Coast energy or gas prices in particular, we think the outlook there looks pretty positive over the medium term. So we have exposures to Cenex and Cooper, which is going through some teething issues at the moment with the commissioning of the Orbost gas plant down here in Victoria. But we think those will be resolved in the medium term. And that stock looks pretty good value on a 2 to 3 year view.
Nick, there seems to be a heap of mergers and acquisitions popping through around the market, as you said, with with Northern Star merging in the gold space. Are you seeing in current markets like we are seeing, where the gold price is quite high, do you see a lot of mergers and acquisitions coming about in those markets?
Yeah, great question. Yeah, we do. In the Australian mid caps and small gold space, I think there is the likelihood you may see another couple of deals over the next 6 to 12 months. So yeah, I think there's a lot of synergies often to be reached where you have assets that are either ore or mill constrained in various respects, and that was really one of the key drivers behind the Saracen Northern Star deal. So I think it is an area that's ripe for expansion ripe for M&A. So yeah, we do have some ideas there.
And you spoke a little bit before about I guess so NextDC, work from home, people obviously using more internet. So you see NextDC, is that a property and infrastructure play, or is NextDC more of an internet play, an IT play?
Well, it's really both. It's infrastructure, but infrastructure that's really exposed to to technology and increasing obviously cloud computing and data usage. So in terms of going back to say 10 to 15 years, airports were regarded as the high growth infrastructure play. Well, I think now you can probably start looking at data centers as almost as a replacement in some respects for airport infrastructure, because obviously people will be traveling less. I think it's going to take quite some time for travel to pick back up to levels it was, say, in 2019. I mean, I know with our business that we can achieve an enormous amount now over the internet, with Zooms, with Zoom type calls and WebEx and Teams and so forth. I've got a conference on today that's actually up at Noosa, and I'm just dialing into the presentations, and it's like I'm there. It's absolutely fabulous. So, and our whole team can dial in. We don't have to go. So I think the data centers are a massive beneficiary of this dynamic, and I don't think it's going to go back to how it was.
Yeah, no, definitely, I'm with you there. We've had some questions around SHV and MXI. I'm not sure if you're aware of those companies at all. SHV Select Harvest Limited. Considering someone saying there that they might be undervalued with your focus on agriculture. Not sure if
they've obviously just done an acquisition last week of some more almond orchards close to where their existing orchards are. I think it is a pretty interesting medium term play. Obviously, the almond price has been depressed. But I think, the acquisition makes sense, and I would expect that the stock should perform reasonably well, particularly if the almond price can recover. MXI, I think, is MaxiTrans. I think, I haven't looked at that one for quite some time. It's relatively small, so don't really have a view on that one.
No, fair enough. Yeah, it's only a very small cap. Really great questions just come through from one of the members on Facebook. So with the new number of traders that are entering the market since March and the influx of company stock prices rising since that time, do you think that prices are a little bit inflated previous to the fundamental analysis? And how does this sort of change your opinion given the number of traders that have now come into the market, especially in the small cap space?
Yeah, it's a fascinating dynamic. And I think to answer the question generally, yes, I think a lot of valuations are overblown. And it is a momentum-driven market. And with a lot of retail investors coming in, and you can see from the volumes going through on CommSec and the other retail platforms, it is a fairly significant part of the market. I think that's just an area that makes us a little bit cautious. But we need to also recognise that the prices can be driven by retail investors as much as they can institutional investors. So it's just an extra dynamic that we have to take into account and be mindful of.
Definitely. Daniel, mate, any questions?
Oh, yeah, well, I do, but I think, are we still continuing? We've got some more of this presentation to go through, or we finished on the portfolio?
Still got plenty of presentation to go through. Nick, you tell me where you want to go to next, mate.
Probably in terms of just the performance prospects for our fund. I think just sort of going forward, the way we're structured, given our sort of focus on valuation, we've got what we describe as a bit of a barbell structure, and I think given how fragile markets potentially are, recognising that a lot of this is being driven by stimulus, government, central bank, and then obviously momentum. You've mentioned that the retail investor factor coming in as well. When you look at those factors compared to where the underlying economies are performing, I think people just need to be mindful of the potential fragility around the market, and that's why we're structured at the moment with this barbell structure, where we've got some defensive and growth names in our portfolio. So I'm not saying the market is necessarily going to fall over tomorrow, but I think just given where valuation levels are in the small industrial space, the PE is north of 20, which is at an all-time high. It's above a 2 standard deviation level. I think it's similar for the earnings multiples apply to the large cap industrials as well when you exclude the banks. So I think it's just a time to be cautious. As I said, we saw in March what can happen. When if the market does get a shock. So I think that sort of explains how we're positioned. That's probably probably on slide 7. It's really that the last sub bullet point there, that we're mindful that a predominant factor driving the markets has been negative real interest rates, massive liquidity, and also asset allocations towards passive strategies has helped as well. So the index funds have become a bigger part of the market as well. Mm-hmm. So the risks on slide 8, I won't labour these too much. They're probably well known to most people following the markets, but obviously COVID's out there in the US. It's still an issue. I think 34 states in the US have recorded higher levels this month versus a month ago, and that's a potential threat to the US economy and the reopening or the shape of the recovery over there. I've talked about low interest rates, central banks, geopolitical tensions are also out there and are building. We've seen obviously that the rhetoric's amped up between the US and China, particularly over the coronavirus. So it's something that is out there. We need to be wary of. At the moment, all this deficit spending, the markets don't seem to be too worried about it at the moment in terms of the US is running massive budget and trade deficits. One of Trump's focuses has been trying to reduce the trade deficit by doing a better trade deal with China. Now the focus seems to have moved away from that more to COVID. I think in the medium term there is a risk that if the US does lose its safe haven status because of these deficits, the US dollar in the medium term is potentially at risk as well, and the markets could revolt if we do see a greater focus on those budget and trade deficits. And then I think the roll-off of stimulus measures now, I think it's probably less of a risk. I think we've seen the governments are pretty much going all in, trying to keep the economies going, but we do have that disjoint still. Even with all the stimulus, we're still going to face a pretty tough economic environment here. And then probably the last two, Australian house prices, I think, are still vulnerable. You've got a lot of people on effective holidays in terms of their mortgage repayments and so forth. And I think that's the fundamental reason why the government wants to keep everyone employed as best they can, because the knock-on effect to house prices and household wealth will be immense if we do have employment fall, just given how highly leveraged the household sector is in Australia. There's just a brief snapshot of our performance on slide 9. We've had a better year this year. As I said, it's been a bit tough for us over the last few years. Essentially, given our style, we have more of a valuation focus, and there has been a very heavily momentum driven market. I think for anyone out there, if you are looking at other or small cap or other managers, probably for any investment class, my personal view is you should really consider people's 10-year records where people have been through a cycle or two. Anyone can really have a hot 6 months or a 12 months, and it's easy to get carried away with your success over those shorter periods. But particularly for professional managers, personally, I wouldn't invest with someone that didn't have a decent 10-year record. Just probably turning to the end of it, or the last page of the presentation, just some stock stories or some ideas that we sort of are liking at the moment. I've got 3, and they're all a bit different. So hopefully this will pique some interest. So the first one of those is a company, Austal, which is a value play. It's currently trading on a PE of about 13 times, coming down to probably 12.5 for next year. The company's one of the world's largest shipbuilders, in particular in the aluminium shipbuilding space. They have a key exposure to military vessels for the US Navy. They're a prime contractor to the US Navy for their LCS warships. Notwithstanding, it's a contracting business which tend to be lower quality. This one has pretty significant IP around shipbuilding. It is a low-cost producer, and I think one of the important thematics driving this one is that we're seeing, obviously, with heightened geopolitical tensions, increasing military spend and government spend more broadly. Last night, the US Navy actually came out and enunciated a new force structure target, taking the Navy up to 500 ships. So it's a pretty sizable increase in ships that the Navy wants to build over the next few years, and Austal's a key potential beneficiary of that. I think the other key point with this company is, with all the boats they've been building for the US Navy, there's more and more of the boats obviously going into the water, and there's a big opportunity for them to generate more sustainment revenue out of the boats, essentially servicing the boats and maintaining them once they go into the water. And we think that's one of the key things that the market's underappreciated at the moment. In terms of why the stock's trading at 13 times earnings when the small industrials is at 2021, essentially the market's concerned about a particular contract rolling off for the company for the LCS program in 2024. We think those concerns are probably overblown, particularly given the factor I just mentioned. The US Navy's come out with this plan to substantially increase the fleet over the next 15 to 20 years. And the Navy's actually just granted Austal, given them, the US government has $50 million to build a steel shipbuilding facility next to their current aluminium building facility in Mobile, Alabama. So we think it's reasonable to assume that the government wants to keep that shipbuilding facility going beyond the roll-off of the LCS program. Otherwise, they wouldn't have given them $50 million to build a new facility. It's a pretty tough, economically exposed state in Alabama, and I think Austal's the second largest employer. So it's highly likely that the government / Navy in the US will want to keep that facility going, and we think they should generate some good levels of work going forward. So we think, the market's concerns are overblown. And trading at 13 times earnings, as I mentioned, and stocks, I think it's got about a 2.5% yield. It's a potential candidate for a re-rate over time. The second stock I'd like to mention is a bit more of a growthy infrastructure play. One of the mid-sized telcos, and that's Unity Wireless, UWL. The market cap's about 700. It's going through a merger process, as I mentioned earlier, with Opticom, which is, I think, got a market cap of about 600. So once they're put together, which we think has a very high chance of occurring, will be about a $1.3 billion company, and makes it pretty significant for small cap investors in the part of the market where I operate. But really, the key business here is a fibre infrastructure business to new or greenfield properties, so both apartment and broadacre housing developments. So really the company, or these two companies, are trying to compete with the NBN, and when they merge, they'll be a pretty formidable competitor to the NBN in terms of rolling out fibre infrastructure to new premises. So essentially, they're the essence is they're much more efficient, faster, more flexible than the NBN co, and can add over-the-top services. So if you're building a housing development, you want security and so forth incorporated. When the development's done, or other bells and whistles, they're much more nimble and able to offer all those extra services than the NBN co is. So essentially, that's where their competitive advantage lies. We really like the business because they're long life, effectively monopolistic assets like the NBN, we think, notwithstanding the recent things announced, where the NBN has obviously got some more funding from the government, we think the NBN is more likely to attack the wholesale enterprise market rather than the wholesale residential market, which is where Unity and Opticom operate. So we really like this one, taking a 2 to 3 year view. It's like an infrastructure growth asset. It's not dissimilar to the data center thematic that I mentioned before. And then probably the final one I'd like to mention. This one's a bit more at the exciting end of the spectrum. This is a medical software company that's recently listed about 3 months ago, called 4DX. That's the ticker of the company as well. So this is a medical software company that runs effectively, it's a SaaS business model with exposure to the healthcare market. So you've got a great business model in that it really is a proper SaaS business model, and the healthcare market opportunities are typically very, very large. Often they involve devices and so forth that need to be produced, or drugs that need to be developed, and that obviously usually costs a lot of money to go through trials, phase 3 trials and the like. This one's great because it's actually a software company, and essentially what 4DX's offering is it's software that's used to measure lung airflows by effectively processing a series of X-ray images. So it takes what is an existing technology, basically an X-ray of the lungs, or a series of X-rays of the lungs, and then processes those using its software, and then effectively provides a dynamic, a motion-based series or image of the lungs and how the lungs are operated. And effectively that provides really rich information for doctors looking at the performance of the lungs. They can much more readily identify where the issues in a person's lungs are. So it's a great technology, and the beauty of it is that it's a very efficient add-on for hospitals, because essentially all they do is upload the X-ray images that they already have and up into the cloud, and 4DX's software processes those X-rays and then sends back a rendered moving image, a 4-dimensional image of the lungs, and it's pretty cost effective too. So at the moment they're looking at basically a cost of $120 for the X-rays and then $175 for the test. So it takes the total cost of 4DX is offering up to about $295 versus the most common alternative at the moment is a CT scan, which involves more radiation, but also costs a lot more, about $575. So it's cost effective as well. Provides great information. The company's just got TGA approval in Australia and are expecting commercial sales next calendar year. So it's basically pre-commercial revenue. They do have FDA clearance in the US and are getting a little bit of revenue over there. They're in the process of building out key opinion leaders in the US. They're at 6 hospitals, some of the majors such as Johns Hopkins, Cleveland Clinics. So it's a pretty exciting opportunity, large addressable market. The founder is a really interesting guy, a guy out of Monash University, Andreas Forrest, who had a background in aeronautical engineering, and that was how he developed the software that is now essentially being applied to these images of lungs. So yeah, really interesting, and also in the medium term, there's scope for new products too. Obviously, at the moment, the first one is one that measures airflow in the lungs. They're working on another one that looks at blood flow or monitors blood flow in the lungs as well. So again, another potentially significant addressable market. So there's 3 stocks for you, a range of styles, but 3 we think have pretty good medium-term prospects.
Very, very range of styles. Couldn't agree with you more there. Getting involved in something like 4DX quite early on, you said it was only listed like 3 months ago. Did you get involved in them on IPO?
Yes, we participated in the IPO. The particular fund I run isn't able to take pre-IPO stakes. So some other small cap funds or micro cap funds are able to do that. We were aware of it at the pre-IPO stage, but our fund came in at the IPO stage.
You get a lot of excitement around IPOs and new listings, and everyone wants to get on the CSL at $4 and write it to 300, or the afterpay at 2 and write it to 100. How tricky is it to pick a good newly listed company?
Yeah, great question. I think over my career, it's not easy. I think in more recent times, it has been probably easier, just given that the market has been momentum driven. And there has been a lot of excitement around, particularly, the buy now, pay laters, and now some of these medical, companies that are coming out, like 4DX. So yeah, I think it can change over time. I think what we're seeing now though is that a lot of these tech-based floats and companies that are coming are, because of this acceleration of the transformation of the economy that's been driven by COVID. There is massive disruption that's coming through from a number of these businesses. So I think at the moment, the markets the outlook's pretty good for technology-related IPOs that are disruptive, I think people are willing to look at the potential medium-term opportunity in valuing these companies rather than being so concerned about whether they're going to be making losses for the next 1 or 2 years. Yeah, but it's an area where you do need to be careful and pick your winners.
Yeah, definitely. Couldn't agree more. Daniel?
Nick, the 3 stocks you put forward, I noticed they're in sectors of defence, ITT and medicine. Is that really in line with Karara's strategy around dealing with the next sort of 2 years of a potentially COVID universe?
Yeah, great question. It's well, as I mentioned, part of our process, we do take into account the top-down thematics, and we are favourably disposed towards those those things that you've just mentioned, Daniel. I think fundamentally, though, each of the businesses, looking at them from a bottom-up standpoint, you can see how their outlook, revenue and earnings will improve, quite well over the next 2 or 3 years, and that's really the key driver. It's more just an outworking that at the end of the day for us, that they're the sectors that they've ended up in.
Even in the COVID world, they'll probably do quite well.
Yeah, exactly.
Without a vaccine. Yeah. One of the rules of Karara's investments, as I note, was underappreciated, mispriced, and sustainable earnings. Well, obviously, everything at the moment is probably underappreciated, potentially, if a vaccine is made available. What are some of the sectors that Karara is kind of looking at in a post-vaccine world?
Yeah, it's an interesting one. I think in a post-vaccine world, which my personal view is we probably won't see it until the middle of next year in terms of it being distributed, widely distributed, allowing for production times and so forth. So we're probably looking at more of a late 21, 22 type impact, for that. But I think, key sectors that would pick up there, you'd expect, anything, travel related. And then I think really the way we're looking at it from our universe of stocks is, the potential changes that you would see then would probably be a reopening of the international borders. So anything that would, has been exposed to inbound, tourism, migration. So that would tend to be suggestive that over that, the year or two following that, anything, housing, in terms of net migration would start to pick up again. And anything inbound tourism related, maybe education with the university sector, in Australia has obviously been hit pretty hard by the foreign student numbers, falling. So, companies like IDP Education, well, they've got the beauty that they're a global business. They can shift their students around the globe to some extent, but they've got a pretty big exposure to Australia. But I think, if you saw a vaccine and things really start to reopen, companies like that would be pretty well positioned. But I think probably the key here is just around this digital disruption. We don't see this as being just a short-term thing, that's been COVID driven. I think this is a structural change now, that's caused permanent changes in the way, business, can be done. As I mentioned at the start, it's massive for us in our business. We our travel budget, won't be nearly what it was in 2019. I think for quite some time. Probably barring international trips, which we probably don't expect to do for the next couple of years.
Yeah, and just on that before we finish that, so in the short term, which sectors do you think are going to yield kind of instantaneous benefits from the introduction of a vaccine?
Instantaneous benefits, right? That's always a little bit hard. I'd say probably the travel would be the main one. I think where we see value in the market and the sectors where we think could really, really take off over the next couple of years, we're probably quite positive around resources, to be frank, because I think if we see a vaccine and economies recover and businesses open up and the economy goes back to how it was, I think you've seen China probably has been the best example so far, that they seem to have got the virus under control better than, say, the Western Europe and obviously the US. But China is seems to be almost back to how it was, and the demand for commodities out of China, you've only got the iron ore price and so forth, and the copper price and what have been going quite well. And what you've had is over the last couple of years, a lot of underinvestment in new mines. Mines have been high graded, all the easy ore's been taken, and so forth. And if the demand for commodities really picks up without meaningful increases in supply coming on board, obviously by definition, with demand increasing and supply not pricing for commodities will be quite strong. And I think you overlay with that what's happening globally with global monetary policy and what the central banks are doing, particularly in the US with the Fed creating money out of thin air. I think that augurs very well for global commodity prices. So I think the small resources part of the market is potentially set up to have a move like it did in 2011. And all commodities could really take off. That's I think if the global economy really starts to to fire, other than technology, which for the reasons I think technology is going to do well, and those disruptors either way. But I think if we do see a vaccine and the economies pick up, commodities could really do fantastically well.
Just on that commodities, with that commodities and mineral space, you're obviously very well versed there. One of the businesses one of our members asked about was ADN, Andromeda Minerals. I'm not sure if you've looked into this company at all, or how you see that as from an operational perspective.
No, I haven't. I haven't looked at ADN. I'm sorry, I can't offer a view on it.
That's good. We throw these things out there. Don't expect you to know everything. There's been a question around BrainChip as a small cap. I've never heard of it. I'm not sure if you have.
Yeah, it's a technology, another technology company. We haven't done too much work. I think it's had a massive run. So yeah, I probably wouldn't offer a view at the moment on that one either. Sorry.
Yeah, no, clever. That's the answer we want. You can only become expert in so many businesses and find the ones you love, and that's why sticking to an investment philosophy, I guess, is so important. And that's why I guess a lot of my clients, we entrust the funds of expert managers like yourself, and especially when you've got such a wide-ranging investable universe. How many companies fall into your investable universe in the small micro-cap space?
Yeah, it's interesting. We start X100, so it's I haven't done a recent count in terms of the potential universe, but it's over a couple of thousand or probably more. But we end up screening down to a realistic universe that we can invest in, given stock liquidity and the number of stocks that we can hold in our portfolio. It acts as an effective constraint on how many you can or what size you can really go down to. So and how many you can look at. So we probably follow actively or keep on our screens probably about 200, but we really follow closely about 100 in our team of 4. So it ends up probably being around 25, 30 stocks each that we know really well, and then a lot of others we know pretty well. But I think to your point that in terms of people's portfolios, it's great to have your money that you're happy to invest with yourself and have some ideas or a more speculative part of your portfolio, but it's obviously good to have a solid part of your portfolio as well. So I think I think when the market's flying, it's probably easy to get carried away sometimes with some of the momentum and exciting stocks.
Yep, definitely. And just on that point, I might introduce Renee. Renee takes care of a lot of the distribution for Karara. Renee, if you wouldn't mind, just for anyone out there who is listening who might want to find out more about Karara, would you mind just introducing how they might be able to do that?
Yeah, sure. Thanks, Stefan. Sure. If anyone out there is wanting some more information, probably the best port of call, I'd direct you to our website, which is www.ironbarkam.com. And there you'll be able to find a link that will take you into Nick's fund specifically. And if you're wanting to speak to someone over the phone, there's a phone number, or there's an email address there as well.
Beautiful. Daniel, any closing comments, matey?
No, just look, thanks, Nick, and thanks, Renee, for being part of our education series. It's been great to have you here at ASX Stock Tips Group. I'd love to have you back in a few more months' time and have a bit more further chat about where the market's at, and maybe that'll be a chat in a post-vaccine world.
Pleasure. Thanks very much.
Any closing comments for any of our investors out there, a part of the group? Some words of wisdom, perhaps, for any of the traders?
Probably, yeah. For traders, I'm not a trader. I'm more of an investor. So I far from me to be giving traders advice, but I think if I did, it'd be obviously run your stop losses, with discipline, and occasionally take some profits.
And with Nick, I'm an investor as well. And at ASX Stock Tip Groups, look, we love to promote rockets. Everyone wants a rocket or two in their portfolio, but also just remember, invest with diligence, do your own research. Thanks for listening today. But if you are thinking of investing into anything that's been mentioned, make sure you do consider getting some professional advice. In saying that, everyone, that's enough from us today. Thanks a lot for all your questions and for everyone listening out. You can get access to this video on the Investor Types YouTube channel. Daniel, thanks again for starting the group. It's been great. Nick Greenway, very much big thanks for joining us. And Renee, thanks a lot for setting this all up. So appreciate it. I'll speak to you all soon.